Good day, doctor. My name is Ming, matrix number 269572. Today, I will present about the internal and external factors to the credit risk of Royal Bank of Scotland. The bank is actually located in United Kingdom. The bank is actually the multinational banking and financial service, and it actually offers very lot of product and service to the individuals, others, and the business. And the problem of the bank is actually having credit risk. So the bank's will collapse is not unexpectedly. We can see from the balance sheet, it's actually ballooned to 3.3 trillion. So it's quite a huge number for a bank. So why will become so large? The root cause is the weak decision is making by the management team of the bank. During 2015, the bank is actually set off very lot of workers due to the bank did not have the enough capital to hire them anymore. The net loss of the bank in year 2015 and 2016 is recorded as 1.98 billion and 6.95 billion respectively. The bank is without profit continuously 9 years. And lastly, the banks managed to pay their first dividends to the shareholder in year 2018. So for here, I actually denote the credit risk as my dependent variable. The internal factors consist of return on asset, return on equity, leverage, MGT, risky sector finance, debt to equity, debt to asset, REGCAP, loan size, liquidity risk, equity multiplier, and last is the risk-weighted asset. So meanwhile, for the external factor, there are inflation rate, interest rate, GDP growth, consumer price index, which is also called by CPI, entry, the money supply, and last is the yield curve. So for this, I actually emphasize on the variable which is significant to the credit risk. So for here is return on asset. The return on asset is actually the ratio of the net income produced by the total asset of the bank. So the return on asset is also the indicator to determine the profitability and the efficiency of the bank. So we can see from the return on asset ratio to determine whether the bank managed to generate their profit well or not. So we can compare the performance between a company but need to in the same industry. So when the lower return on asset ratio is actually mean that the banks did not fully utilize the asset efficiency. Meanwhile, for the bank has a negative return on asset, it actually means that the yield will have a negative return also. So for here is methodology. There are 4 steps. First is sampling technique. The data of the dependent and independent variable is actually analyzed from the annual report of the Royal Bank of Scotland within this 5 years. Next step is statistical analysis. So we need to measure the credit risk from the bank that influenced by the internal and external factor. Third is the data analysis. I already denote the credit risk as my dependent variable. So meanwhile, the other variable is the independent variable. Last but not least, I actually use the SPSS statistical analysis to find out the multiple regression need to apply to determine whether the impact of the independent variable toward the dependent variable. And actually, I have 3 models, which is the model 1 is consists of the internal factor, model 2 is external factor only, and the model 3 is actually consists of the internal and the external factor. So I need to investigate whether which model is strongly affects to the credit risk. Here is the analysis and the finding. So this table is the Pearson correlation, and we can refer to the size of the correlation. So when it's recorded as 0.9 to 1, it actually means that this is very high relationship to the credit risk. Okay, on the other hand, when it's recorded 0.0 to 0.3, it is negligible. So this means that the variable did not affect the credit risk at all. The return on asset actually highlight So the return on asset is actually recorded as negative 0.993. So actually this means that the return on asset is strongly affects the credit risk since it's recorded as 0.9, right? Meanwhile, the NGT is recorded only 0.05. So actually this means that the NGT did not affect the credit risk at all. So for here is the model summary. Model summary where we need to emphasize on the adjusted R square only. The adjusted R square record as 98.1%. So this is mean that the adjusted R square is able to explain 98.1% of the variance only. Meanwhile, for the remaining 1% is actually consists as unknown. Next is the coefficient. So for the coefficient table, we need to see the t-value and the significant value. So the p-value is smaller than 0.001 is actually strong relationship. Meanwhile, the p-value is smaller than 0.05 is moderate, and last is smaller than 0.1 is actually mean is weak. So for the return on asset, we can see that the significant value is smaller than 0.001. So actually this means that the return on asset is fully or strongly affects to the credit risk. So on the other hand, we can see the t-value of the return on asset is recorded as negative 14.372. So the negative is actually mean that it has a opposite relationship with the dependent variable. For example, the return on asset ratio is getting lower, the credit risk will getting higher, or the return on asset ratio getting higher, the credit risk will getting lower. So this is the result from the model 1. I actually use the stepwise method instead of the enter method. So this managed to let me find out whether which variable is managed to affect the credit risk. Last is the conclusion and the recommendation part. So for here, I actually investigate and find out the return on asset had a significant relationship with the credit risk. So the bank is actually need to have a good reputation to the investor and the society. So why? Because the investor will refer to the annual report or the financial statement of the bank. They need to see whether the performance of the bank is good or not. So they can trust the bank and willing to invest it. Improper credit risk management will lead to reduce the bank performance. Just now I said before, the bank's performance is actually consists of the profitability such as the return on asset, return on equity, and others. So this is the point and the data for the investor to investigate whether which bank is better, is suitable for them to invest and can get a higher return. Next is the lower asset quality. And last, improper credit risk management will lead to an increased borrower default. So when the borrower did not manage to pay back their payment, so this will let the bank has a crisis, which is the credit risk. So the credit risk happen, it also will lead to the liquidity also, because the bank did not have the enough capital to operate it. So the management team of the bank is actually need to think and choose a proper risk management technique so they can avoid the risk and has a better decision making while did not lead the banks to collapse or has anything problem anymore. So the banks is actually they need to have a suitable way or the technique to reduce the risk happen again. That's here for my presentation. Thank you.